would start investing. No frills, no bullshit. This is a video precipitated by one of my friends that I went to officer candidate school back in 2012 with. He reached out with this exact question, and I want to make a supplementation video for him and for other people because I know others have this question. So let's get straight into this thing. Very first off, we have what happened here. Well, this is it. And overall, this is just my buddy reaching out saying, hey, I'm curious at what to do with my money, because he makes really great money now, which is awesome, but he acknowledges that his investment knowledge is not right, and he's looking to get educated, which is awesome. It's exactly why I do this. So I referred him to this blog post right here, and it is a big post that runs through literally, if you know nothing, it teaches you why investing and a lot of supplementation on how to go from nothing to actually opening up a brokerage account and being able to put on a buy and hold position. But I wanted to color in some of the shaded areas for him, and hence let's get straight to it. So the very first thing I would advise myself if I were to start investing is to start with goals. And I refer to this all the time. It's from Stephen Covey's 7 Habits of Highly Successful People. And this is begin with the end in mind. This is super important because depending on what your objectives are, you have to behave differently. So what I would do is outline a 20-year, 10-year, 5-year, 1-year goal that is specific, measurable, achievable, and time-bound. So the idea here is right out of the gate, we are outlining for ourselves what we want to accomplish. So in 20 years, I want to be fully retired. In 10 years, I want to see clear progress that within the next 10 years, I will be at my benchmark. Over the next 5 years, I want to create the supplementation skill set, income streams, those kinds of things. And then over the course of this year, I want to start investing. I'm going to save X number of dollars per month, that sort of thing. So once we have our goals outlined, we need to assess our savings, and we need to save more aggressively than where you're at even right then. And it's a guarantee, because no matter what, the earlier you start saving and prioritizing that, the earlier you get to this fabled early retirement that you then don't have to worry about money ever again. And you can start buying things that you want without worrying about if it's on sale or using coupons. You get to stop worrying about money. The way you get there is by sacrificing near-term outcomes. So yes, you might not be able to go to the club 3 nights a week and spend $1,000 a week trying to do that. But if you give that up front and embrace delayed gratification, you can start achieving much more interesting outcomes. So for here, if you were just saving, let's say you had $100 a month for 30 years, that gives you $36,000. However, if you have that same $100, you're saving that $100 per month. Over the course of 30 years, if it was invested, is $200,000. This is exactly the point I'm trying to help express to people, that saving is a giant amplifier for investing. So to recap these two, outline what you want, start saving, and get religious about it. It should be automatic every single month. The worst thing you could do is say, oh, I only have $50, so it's not worth saving that. I'll wait until I have more and then save. That's probably the worst possible behavior you could have, because then something always comes up. There's never a great time to move a bunch of money away. So you just put what you can and keep doing that automatically without fail. That will get you much further than like waiting for an amount that you think is good. Now, you're going to need a plan. For the traders, which is one of the paths we're going to be talking about in a minute, for the traders, this will be your trading plan. If you are just an investor that you want to get into buy and hold and not mess with any of this other stuff, that's totally cool. And for most people, that's smarter, because most traders don't make it. So if you're going to go down the passive route, you still need what I would refer to as a wealth development plan. And this is a place for you to outline your goals, your savings protocols, because writing these things out, 1, makes them more powerful, 2, allows you to test different things so that you can maybe try in your investing portfolio, maybe you try rebalancing it every 6 months, but then you test trying it every quarter and you can see the outcomes there. So this gives you some structure on what you're looking to do. And if you are part of the Patreon, you get this trading plan template for free. You can go download it at any point if you're silver or above. And if you're not, you can check out this video in the notes below that walks through this exact concept in detail so that you can just make your own as we move through the video together. But you need the plan, whether you're going to actively trade or not. And again, that leads us to kind of these two different paths. And I just want to talk about the difference between them. For most people, passive investing, buy and hold investing is going to be a better route because you really get to capture most of the benefit, right? That 80-20 rule. You could put in a very little amount of effort and capture the majority of the benefits of investing in the stock market. You also get better tax treatment if you're holding products for longer than a year. The whole idea of actively trading is really for 2 or 3 purposes as far as I can see it. The first purpose is to outperform the stock market. And the reason why that matters is I will show you this right here. If we go to this compound interest calculator on my website, which is totally free, we can use the standard amounts here. And let's just say you're saving that extra $100 a month. Let's just put this out to 20 years. Okay. So now let's say that the stock market is somewhere between 7 and 12%. So we'll leave it at 10%. This is your return if, let's just say, you're buy and holding at this rate with the savings. However, if you are able, let's say, to add 5% on top of that, notice this kind of blue line with the triangles. All of a sudden, you would go from that $102,000 to $205,000. That's if you're able to return 15% versus 10%. So the whole idea here is if you are an active trader, the first goal is to outperform the market. The second goal could be for income. You can trade different styles to generate monthly, quarterly income. Or you can trade to reduce portfolio variance, but that's not really a great approach in my opinion. If you're going to trade, it should probably be, at least if it were me, for one of those 2 reasons that I mentioned in the beginning. So let's talk about the environment real quick. We already know why we're investing. We're going to take a risk for a return. When you put money in the stock market, you are committing capital, which is at risk. It can decline in value or even go to zero, but we're doing that for the sake of a return. So when we think about the stock market, if you are brand new, this is really all you need to know, is that there are different securities that make up the stock market. These are just the products you can trade. And there are things called equities, derivatives, and debt. Debt is exactly what you're used to hearing. These are your bonds that you can access. Derivatives are things like options and futures. I primarily trade options, so I operate here a lot. And then equities. These are things like individual stocks. So if we take a look at this is the stock market. These are all of the different kind of products that you can trade. You might notice some of these names, like this one, AAPL, that's Apple. You probably have heard the term the S&P 500. That is this product here. And these are all of the things that are within the S&P 500, like Microsoft, Apple. It's a bunch of different stocks that are put together. That's called an index. And there are things called exchange traded funds, ETFs, that essentially allow you to trade this index. So if you buy something called SPY, SPY, you gain exposure to all of these different things in that one product, which makes it very efficient, which we'll get into a little bit later. Now, how do you do all of this? Well, you need a broker. So if we take a look now and you just throw into Google online brokerage, you can see all of these different brokers that pop up. If it were me, I would direct myself towards Interactive Brokers, TD Ameritrade, E-Trade, Schwab, one of those. I personally use TD Ameritrade, and part of that is just because of luck. It is what I happened to pick when I started trading back in 2007, and I like them, so I stay with them. But you can pick any of these major brokers. I would avoid places like Robinhood. They're not really a great broker specifically for active traders. For passive traders, it doesn't really matter as much. Kind of pick whatever makes you happy. But the broker is what gives you access to the stock market so that you can then start taking a look at these different things. So now let's get into kind of the rest of this thing. If you are going to invest, which is kind of we're thinking about holding things long term, longer than a year, or trade, which is when we're buying and selling within a year, I would start with buy and hold. It's the same thing for both. The reason why I would start with buy and hold is because if you're going to be an investor, well, this is all you're going to do going forward. And if you look at something like a buy and hold portfolio, this is from portfoliovisualizer.com. If you are looking to invest, this is a great place to check out. I'm not affiliated with them at all. They just have a great product. So you can go to backtest portfolio and you can change this time frame to whatever you want. You could drop in all the different symbols that you want to take a look at and you can see how they perform. So what I did here is give you a few different things to look at. This blue line, which is portfolio 2, is 50% IWM and 50% QQQ. These are two index ETFs. This is the Russell 2000 and this is the NASDAQ. So if you take a look at this and we look at the NASDAQ 100, this is QQQ. So you're getting exposure to all of these. And when I'm talking about IWM, this is 2000 small cap stocks. You are gaining exposure to all of these. So that's one portfolio. Another idea here is 60% SPY, which you know what that is already, and 40% TLT, which is 20-year US government bonds. And you can take a look at what the final balance is between these, what the compound annual growth rate is. And if you notice, compared to the S&P 500 by itself, if you do something as simple as IWM and QQQ, you outperform it modestly. Now, you can take a look at the worst year to see if you're comfortable with the drawdown that you might have. The max drawdown is the lowest it gets at a certain point in time. But the cool part about this kind of product is you can get an idea of how different things work. And if you are a buy and hold investor, again, if it were me, I would literally just pick SPY. And every single month, put more money into your brokerage account so that I could buy more shares of SPY and just do that into perpetuity. Because if you take a look at this for the period that we're looking at, which is 2010 all the way through current day 2023, if you have a 12.12% compound annual growth rate, well, let's come back to this. Let's get rid of that. And let's instead look at if we have that 12% compound annual growth rate and what that can do for you. Specifically, if you get more serious about saving, which is that thing I kind of reminded you in the beginning. So instead of $100, let's say you could do $500 a month. Well, now in 20 years, you essentially have $500,000. That's starting with just $5,000. And let's say you get better at saving, or let's say over the time span, your average monthly contributions grows because your income is growing. And let's say you could do $1,000, not in the beginning, but over this 20-year period, that becomes your average. Well, now you're a millionaire. Done and done, starting with $5,000 at the average stock market return. That is the beauty of investing. So in this case, you can tinker with different things, find what you like, but this is just to give you some ideas on where you can start. Now, for the people that are trading, it's a little bit different because investors from here, they just have to monitor, save, buy more on a regular cadence and rebalance if they want. But again, if you're just using one ticker SPY, then you're done. And you might get to a point where you say, I want to decrease a little bit of risk. I'm getting closer to retirement. Well, that's pretty simple. All you do is modulate how much you're putting in bonds. So let's say you're getting close to retirement. You're not looking to grow your money anymore. You just kind of want some income and to protect your capital. Well, maybe this goes to 20% S&P 500 and 80% TLT. The point is this can be modulated to whatever you need based on your needs. However, for the traders, this is when things start getting serious. You are going to have to create that trading plan that I was telling about. You are going to have to start paper trading to figure out what works for you. So if you are going down this trading route, this is a whole whole other world that I will create a second video for you on that dives into that specifically. But up until this point, it's the same, whether you're investing or trading. So I hope that this helps everybody out. If you have any questions, comments, concerns, drop me a line, let me know. And don't forget, a little bit of delayed gratification upfront can really change your life further down the line. So get consistent, embrace the process, and watch you become an outlier. Catch y'all later.